In a hot market like we're in right now, it is common for you to have to bid over the list price to be competitive with other offers. So what do you do in that situation, and what happens when the appraisal doesn't come in for the offer price? So you do have a couple of options. Typically on a contract, when you're bidding over the list price, you're going to have to sign some sort of appraisal waiver document. It may be a partial waiver or a full waiver. What that means is, let's say you're offering on a $300,000 home, but you offer $330,000, but the house again was listed for $300,000. You will most likely sign a document that says you will pay the difference in the offer price and the appraised value, either down to the list price or $15,000 or whatever the appraisal comes in at. So although there are too many variables to talk about here, we'll talk about the most common ones. Typically, when you are offering over list, you are going to be responsible for the difference in potential value versus the price. And in markets like this, appraisals are commonly 2 to 3 months behind the actual value. So in that same example, if you offer $330,000 and you're looking at the trends and your realtor is helping you and you're like, well, this house will be worth $330,000, the appraiser is going to look at it through different lenses. They are regulated. They can only look at appraised values from the date of the inspection and use comparables from the date of the inspection on other closed sales from that date going backward. So that is why when you have a market that's appreciating rapidly, appraisals just take some time to catch up to that. So don't be nervous if you've got good advice from your realtor, and it's especially one of the trusted realtors that referred you to us. They know what they're doing, and you just have to pay the difference right now. Some markets and some sub-markets, man, there's so much activity going on. There's been enough sales that are now justifying those higher values, and some appraisals are coming in at higher than list price. Some of them are coming in at the offer price. But let's take the worst case, more common worst case scenario that happens right now. So let's take a little higher purchase price example. Let's say $450,000 purchase, right? To get it, you got to offer a little over 10% to get the offer accepted, let's say. That's very common right now as well. So you offer $500,000. You look at the numbers, you say, okay, worst case scenario, talking to the realtor, this is going to come in at $450,000. So there are two options in that scenario. Number one, you can keep your loan to value the same. So let's say you're putting 20% down. Well, initially you were going to put 20% down on $450,000, right? That would have been $90,000. Now you offered $500,000. So if the appraisal had come in at $500,000, you'd put 20% down on that, and you'd be financing $100,000 in a down payment. Okay. In this scenario, though, it's a little different. You offer $500,000 for a home that, let's say, since the seller and the listing agent listed it at $450,000, it's going to come in at $450,000. Let's just assume that. Well, now your down payment and your loan to value calculations are all based on the appraised value or the sales price, whichever is less. In this case, you offered $500,000, appraisal came in at $450,000. Now you're putting 20% down off the $450,000 and bringing an extra $50,000 to the table to cover the difference between sales price and value. So you've got $90,000 for the down payment and another $50,000 for the difference. So now you've got $140,000 out of pocket. So you can do that. No mortgage insurance. Keep it at 20% down. If you say, wait a second, I still just wanted the $90,000 out of pocket, or whatever it is. In that scenario, you have the second option, which you can go, all right, well, it came in at $450,000. I offer $500,000. Now I'm just going to move to 10% down. Well, now you do 10% down off the $450,000. So that's $45,000. You got a $405,000 loan amount, and you cover the difference. So now you've got $95,000 out of pocket. So that is the way to keep your cash to close the same, but now your loan to value calculation is a little different, which means you do have a small bit of mortgage insurance on there, but you can keep your cash and your payment very similar. Other scenario, more cash out of pocket, no mortgage insurance, and a lower payment. But again, there's less funds to you, less money in your pocket, more to the loan. If you want a detailed example of this, go to the link below this. It has the analysis with all the numbers in there that I hope will help you. If you have questions, we're just a phone call away if you need us, or an email. Otherwise, I'll see you on the next video. Good luck out there and happy hunting.